What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Lululemon because the stock is down over 15% today. And based off of what I see off of Qualtrim, it looks like the shares are down because the company issued weak guidance and the analysts lowered their price target. Now, Lululemon is a pretty big and popular brand. I've owned this stock in the past, which let's go down here and see where did I last sell it at. So I last sold it at 390, 400, 406 back in December of 24. So that was 4 months ago, roughly. And I remember it was, look at the last 5 years. This stock just goes up and down. It doesn't really go anywhere. It's pretty much been sitting at 300 and, $20 a share the whole time. So I'm not really a big fan of this stock just because for that reason it's not consistent. And I like consistency, as do most investors are looking for consistency in a business and in the stock. So we're looking at a $34 billion company. This company is doing, let's see, trailing 12 months, they're doing 10 billion in revenue, which that's not terrible. It's a price to sales of 3. That's not bad. Net income of 1.7 billion, which again, not terrible. It's at least, there's a lot of companies that trade at 50 times earnings and it's kind of just ridiculous. But 1.7 billion is not bad. A PE for this year of 19 times. That's not bad either. And then 19 times for 2026. Now let's go into here and see. They have EPS of 15.3 expected this year, and then 17. So the numbers look good. 6% growth, and then accelerates to 8% next year. That all looks good. Those are all good signs. But they did issue weak guidance, so things may be changing a little bit. Forward PE of 22, right along the average, I would say. I mean, it's been anywhere from an 18 to a 32, so 22 is really on the lower side of things. So price to earnings is not that bad. Price to sales of 4. So see, as of right now, it doesn't look bad. But the problem is, the you know, why has their numbers gone up for the last 5 years? Right? You look at the last 5 years. So 700 million, they're doing more than double what they were doing just a couple of years ago in net income and revenue, but the stock hasn't gone anywhere. And so it's like, why is that? What's going on here? So I mean, look how these are really nice trends. These what's the average revenue growth? 21% growth the last 5 years and for revenue, and 23% for net income. Those are great numbers. This stock should be trading at 30 times, right? I could see it trading at 30 times, at least 25. So I would say, yeah, I mean, I think the stock should be roughly a 40, $45 billion company. Really, I don't see why the stock's not closer to $400. Um, so we'd have to find, what are they doing that's not consistent here? Let's see return on capital. Return on capital is still strong, 40%, very strong number. Profit margin, it's keeping up, if not getting better over the last 5 years. So 17% margins are not bad. And then we go to the valuation here. Price to earnings the last 5 years, it's come down a lot, which that's probably just because their growth is, I think it mainly goes back to their growth is slowing. Even though we see here that revenue is expected to accelerate a little bit, it's still not what it was. Remember, this company last 5 years was growing over 20% a year. Now they're growing 6% to 8%. So, and I think it's mainly because of the competition. I think you have a lot of other companies doing similar things, and this company has not found another way to innovate or to come out with a new, you know, avenue of products to where they can gain a competitive edge and accelerate their growth. That's why they're only growing 6 to 8%. That's at least the way I see it, and that's why I think that PE ratio has come down. The market is not, and investors are not giving this the same premium that they were 3 years ago, 4 years ago, because the growth is no longer at 23%. So when the growth was at 20% plus, that's why we see the stock trading at 50 times, 60 times earnings, which, I mean, look at the past. It's traded up to 80 and 90 times earnings. And then obviously here this year we had a crash, so it came down to 30, 35. And then now we're even below that though. Now, the stock has come down so much to where we're down to what, 21 times earnings now. You see, that's really cheap. But that's what happens. 20 times earnings is what you get when you only are growing 7% per year. So I think it's justified. I think it's justified, and I think this is a fair value for the stock. And it's sad though, because but that's what happens when you trade at 60 times earnings, because you already price in all the growth. At this point, 2021. all the growth has been priced in, right? I mean, if you're paying 350 or $400 for the stock back then, you're overpaying. And so I mean, some of the growth as far as net income and revenue happened. They did grow. They doubled their numbers the last 5 years. But guess what? The stock was already up, and so that's why the stock has gone nowhere the last 5 years. That's why I always say don't overpay for this stuff because this is what happens. I mean, you're just taking the gains from the future, so you don't make any money. So that's the way I look at a company like this. Um, unless they come out with another way to grow faster and they get back to 15% or 25% growth as far as income and revenue, then yeah, it's going to trade at 20 times earnings. And so that's why the stock's not going to go anywhere. You might only make 6%, 8% in a year or something. So that's the way I look at that. The moral of the story for me is just I don't overpay for companies. I do not like stocks that trade at 50 or 60 times earnings. Lately, I really want to buy Chipotle right now, but I won't because the stock's not at an attractive valuation. It's at least 50 times earnings. And the last couple of years, it looks when stocks do that for a period of time, like Chipotle has done that for years, it looks like, okay, this is just the way it's going to be. I'll pay 50 times because that's what the market puts it at. But no, that doesn't, it always comes back. Look at Amazon. Amazon used to do that too. It comes back down to more reasonable expectations. So that's the moral of the story. I will see you guys in the next video.